could have happened using $5, and we want to know whether we use more than that or less than that. Right, so spending variances, the total cost we actually paid out is $10,200. Then the actual cost that could have occurred for these hours would be using a variable rate $5. Okay, so if you use 1,380 times 5, this will give you 6,900, right? But we actually spent 10,200 compared to 6,900. We spent too much compared to the rate that we got earlier. Okay, so this should be unfavorable. So this is the spending variances. So 10,200 minus 6,900 will give you 3,300. So what about the other one, efficiency? For efficiency, we'll be comparing the actual hours used with the budgeted hours. So we already know the actual hours is 1,380 hours. The workers use this. What about the original budgeted hours? Meaning budgeted hours at the level of having 6,900 glasses. So how will we be able to know that? So this is the actual hours. What about budgeted hours at the level of 6,900 glasses? What we got earlier, the 1,800 hours, is based upon 6,000 glasses. But now we actually got the flexible budget should be adjusted to 6,900 glasses instead of the original 6,000. So the 6,900 glasses, based on the rate, each glass should have spent 0.3 hours on it. So there would be 6,900 times 0.3 will give us how much? $2,070 hours, right? 0.3 because earlier the problem tells us that we budgeted 1,800 hours for 6,000 glasses. So meaning the rate that you expect workers to produce one glass is at 0.3 hours, right? So that's like about 20 minutes you want the workers to get done one glasses. But now we use that same rate. We know the actual results we got, the actual 6,900 glasses. So using this rate here, supposedly you should allow workers to use 2,070 hours. But they only use 1,380 hours, so it's actually favorable, cost saving to the business, because we had differences, 20,070 hours minus 1,380 hours. That would be 690 hours favorable. And this hours, we times the original rate again, $5. So we saved 3,450 efficiency-wise. Okay, the following two would be fixed cost differences. So fixed cost, remember we break that down to spending and to volume variances. Spending variances should be the easier one. It's basically actual cost that you spent, which is actual fixed overhead would be 2,830. That's the money that you actually spent. We want to compare this with the budgeted numbers, right? So we have the budgeted rate, and the original budgeted hours is how many hours? 1,800. So the actual cost minus 1,800 times the budgeted rate, 2.5, that should give you the answer for spending variances for fixed cost. Okay, so 1,800 times 2.5 will give you 4,500 here. you know that actually you spend less than what you budgeted. So spending variance is just the difference between actual and the budget numbers. So it's favorable, yes, we spend less. So this part here, the 1800, was based on basically the static budget part, 1800. Okay, so what's a little bit confusing here for the very last part, the last category, the volume variance. Well, volume variance is using budgeted fixed overhead, which you already got from here. Remember, budgeted was the static times the static standard price. But we minus the actual allowed hours. So remember where we got this 2,070 hours from? That was from, remember, the 6,900 classes that we got times the original allowed hours. So supposedly workers could have used this much hours. So this is the in case this is the hours they used, and using the standard price, they should have spent the cost at $5,175. Okay, so this is the $2,070 times 2.5. This could be the possible cost that would occur. But based on the standard price, the budgeted fixed cost, we usually assume the fixed cost is the same across all different levels. Right, so volume variances is just another way to estimate cost, and we want to know that in case that they actually spend the most of it, this could have been the differences. We could have had additional $675 spent. Okay, but since we didn't actually reach this point, so this is actually considered favorable, 675. So these two together is the fixed variances part. Spending variances, volume variances based on potentially what could have been spent. Okay, so in summary, what we've done so far in this chapter was understanding, again, actual results, the differences between that and static budget. We used flexible budget in the middle, set it as the actual outputs to see what was theoretically the expenses and income. But if we do see the difference between these two, then that means it's more than sales volume, it's something else. We might have price variances, efficiency variances, and we break these differences into materials, labor, and manufacturing overhead. That's what we covered so far. Okay, so each part of the variance has price variance, efficiency variance. Labor has price variance, efficiency variance. Manufacturing overhead also has price variance and efficiency variance, and we break that down to variable manufacturing overhead and fixed manufacturing overhead. Okay, so there should be 6 types of variances in smaller categories that you should know. All those 6 actually belongs to, besides the very last one, the upper 5 belongs to flexible budget variance. The very last one here is still part of the volume part, this part. Okay, any questions? This part here, when it comes to next week and you do the homework problems, that will be easier for you to understand more when you go through, but make sure you go through the example in the chapter. Understand the differences between these different categories of variances.